What if I told you that two of the oldest forms of money on planet Earth just delivered the most jaw-dropping price swings in over 45 years, and the wild ride is nowhere near over? Gold surged more than 65% in 2025 alone. Silver, hold on to your seats, exploded 144%. Not in a decade, not across a full market cycle, in a single calendar year. The last time either metal moved like this, it was 1979, and the world was on the edge of total financial chaos. Sound familiar? Right now in 2026, gold is flirting near the 5,000 per ounce level. Silver is swinging wildly between the 70s and pushing toward triple digits, and the exchanges themselves, the people who run the trading floors, are so rattled by the volatility that they've been forced to raise margin requirements multiple times in a matter of days, just to keep things from completely falling apart. We're talking about moves so sharp, so violent, and so fast that even veteran traders are blinking in disbelief at their screens. But here is the thing nobody is telling you. These swings aren't random. They're not noise. Every single lurch up and every terrifying drop down has a reason. And once you understand those reasons, you stop panicking and you start seeing opportunity where everyone else sees chaos. That's exactly what we're going to break down today. The real forces driving these historic swings in gold and silver, what they're signaling about the broader economy, and what smart money is doing right now while everyone else is frozen in fear. If you find this valuable, hit that like button right now. It helps more people find this information when they need it most. Let's get into it. Let's set the stage, because without understanding where we've been, none of what's happening right now makes any sense. At the start of 2025, gold was sitting around $2,600 an ounce. Silver was trading near $29. Those weren't exactly cheap prices. Both metals had already been on a multi-year upward trend. But if you had walked into any financial conference at the beginning of last year and told the room that gold would finish the year above $4,300 and silver would crack $72, most people would have laughed you out of the building. The consensus on Wall Street was that these metals would maybe see modest gains. Maybe. Instead, they delivered the best annual performance either metal had seen since the wild inflationary chaos of 1979. And now, here in early 2026, instead of cooling off, the volatility has actually gotten sharper. So what is going on? Why are gold and silver behaving like this? And why does it matter to you, sitting wherever you are right now, watching this video? The answer starts with something that very few people really take the time to understand, and that's the relationship between precious metals and what economists call monetary credibility. Basically, the degree to which ordinary people, governments, and institutions trust that the financial system is working properly and that the money in their pockets is actually worth something. When that trust is strong, gold and silver tend to sit quietly in the background. They're there, they hold their value, but they don't scream for attention. But when that trust starts to crack, when people begin to wonder whether central banks really know what they're doing, whether governments are spending more than they can ever realistically repay, whether the currency in their wallet is quietly losing its purchasing power, that's when gold and silver start to wake up. And right now, that trust is not just cracking. In many parts of the world, it is breaking. Think about what has happened over the last few years. Central banks around the world went on one of the most aggressive interest rate hiking campaigns in modern history to try to beat back inflation. Then, when growth started to wobble, they pivoted just as aggressively in the other direction, cutting rates and signaling that they were prepared to do whatever it took to keep the economy from tipping into recession. The Federal Reserve cut rates 3 consecutive times in 2025, and Chairman Powell made clear in December that the Fed was also resuming Treasury purchases, essentially injecting more money back into the financial system. For gold and silver investors, that is jet fuel. Every time a central bank signals that it is going to print more money or keep rates lower for longer, the case for holding precious metals as a store of value gets stronger and stronger. But here's what makes the current moment different from previous gold bull markets. It's not just retail investors and inflation hedge buyers driving this. Central banks themselves have been buying gold at a pace that absolutely nobody expected. Global central bank gold demand has been running at historic highs, with institutions averaging around 585 tons of purchases per quarter. To put that in perspective, these are the very institutions that issue and manage national currencies, and they are loading up on gold at a rate that hasn't been seen in generations. When the people who print the money start hoarding the alternative to money, that tells you something very profound about where we are in this cycle. Now let's talk about silver specifically, because silver's story in 2025 and now into 2026 is both similar to and dramatically different from gold's story. And understanding that difference is critical if you want to make sense of why silver's price swings have been so much more violent. Silver, unlike gold, lives in two completely different worlds at the same time. On one hand, it's a monetary metal, a store of value, a safe haven asset, something people buy when they're scared about inflation or financial instability. But on the other hand, silver is one of the most industrially critical materials on the planet. It's in your solar panels, it's in your electric vehicle, it's in the circuit boards of virtually every piece of advanced electronics you own. It's in the data centers powering the artificial intelligence revolution that everyone is talking about. Silver is unique in that demand, for it is structurally increasing on the industrial side regardless of what the financial markets are doing. And that creates a kind of underlying floor beneath the price that simply doesn't exist for gold in the same way. What happened in 2025 was that both of silver's demand drivers fired at exactly the same time. Financial buyers were flooding into silver as an inflation hedge and a safe haven, driving prices higher from the monetary side. And simultaneously, industrial demand, particularly from solar panel manufacturers, EV battery producers, and electronics makers, continued to absorb enormous quantities of physical silver. The Silver Institute has confirmed that 2025 marked the fifth consecutive year of a structural supply deficit in the silver market, 5 years in a row where the world has consumed more silver than it has produced, and yet prices only truly exploded last year. The question that serious analysts are now asking is whether the market was simply late to fully price in the depth of that deficit, and if so, there may be a lot more repricing left to do. But here's where we have to be completely honest with you, because this is a YouTube channel that deals in real information, not hype. Silver's price swings are not just driven by fundamentals. A massive part of what you're seeing in those violent daily and weekly moves, the kind of swings that can take silver down 5 or 6% in a single session and back up again the next day, comes from the structure of the market itself, specifically the role of leveraged futures trading. Here's how it works. When investors want exposure to silver prices without actually buying and storing physical metal, they often buy silver futures contracts on exchanges like the CME Group, which is the Chicago Mercantile Exchange. These contracts let you control a large amount of silver with a relatively small amount of capital. That's the leverage. And leverage is a double-edged sword that cuts in both directions with terrifying speed. When prices are rising, leverage amplifies your gains and attracts more speculators, which pushes prices even higher. But when prices start to fall, or when the exchange gets nervous about the level of volatility and raises what's called the margin requirement, meaning you suddenly need to put up more cash to hold your position, traders who can't meet that requirement are forced to sell. And when a lot of leveraged traders are forced to sell at the same time, prices can crash in ways that have nothing to do with the actual supply and demand for physical silver. This is exactly what played out in dramatic fashion at the end of 2025 and into early 2026. Silver had surged above $80 per ounce for the first time, a level that would have seemed absolutely unthinkable just 12 months earlier. And then the CME raised margin requirements for precious metals, not once, but twice in the same week. The first hike triggered a sharp sell-off. The second one accelerated it. Silver, which had been above $80, tumbled back into the 70s almost overnight. Gold, which is a much larger and more liquid market, saw more modest declines. But in both cases, the moves were driven not by any change in the fundamental story, not by a sudden increase in supply, not by a collapse in demand, but purely by the mechanics of leverage trading unwinding. Understanding this dynamic is absolutely essential if you want to be a calm, rational participant in these markets rather than someone who panics at every sharp move in either direction. Because here is the truth. Margin hikes cause pain, and they cause dramatic short-term price action, but they do not change the underlying reasons why precious metals have been rising in the first place. The trade tensions that drove investors to safe havens in 2025 have not resolved. The central bank buying that pushed gold above $4,000 per ounce is not going away. The structural silver supply deficit that has now persisted for 5 consecutive years does not disappear because the CME asked traders to put up more collateral. These are multi-year, multi-decade forces. Short-term volatility, as agonizing as it feels in the moment, is just noise on top of a much longer-term signal. Let's talk about where we stand right now, here in February 2026, and what the smart money appears to be doing. Gold has pulled back somewhat from its peak but remains in historically elevated territory, with multiple major institutions including JP Morgan projecting prices toward $5,000 per ounce by the end of 2026. The bank's analysts have noted that while this rally has not been linear and will not be linear going forward, the underlying trends driving the repricing of gold higher are not exhausted. Bank of America's metals strategists have echoed similar projections, pointing to continued central bank buying, rising government deficits, and an environment where the Federal Reserve is demonstrably more willing to cut rates than to hold them high and risk a recession. All of those factors continue to support gold at elevated levels and support the case for further gains over the medium term. Silver's outlook is even more dramatic and more contested. After a 147% gain in 2025, some analysts are cautious, wondering whether the metal has run too far too fast and is due for a sustained correction. But others, particularly those who focus on the fundamental supply-demand picture rather than just price charts, argue that silver is actually still in the early stages of a much larger repricing. Gold Silver's lead analyst Alan Hibbard has stated publicly that he expects silver to trade above $100 per ounce in 2026, and he's pointed to the deepening supply deficits, the growing industrial demand from the green energy transition, and the increasing institutional recognition of silver as both an inflation hedge and a strategic industrial commodity. The Silver Institute's data supports the bullish case on the supply side. Inventories on both the COMEX and the London Bullion Market Association drew down significantly through 2025, and physical availability of what's called good delivery bars tightened materially by year-end. Now, there's one more piece of this puzzle that doesn't get enough attention, and it's genuinely important for understanding both why these metals are swinging so sharply and what might come next. It's the relationship between gold and silver, what traders call the gold-to-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, over very long time periods, that ratio has averaged somewhere between 50 and 70. When silver is relatively cheap compared to gold, the ratio is high. When silver is expensive relative to gold, the ratio is low. Earlier in 2025, as gold was leading the charge higher and silver was still playing catch-up, the ratio spiked well above 100. Meaning it took more than 100 ounces of silver to buy 1 ounce of gold. That was a historically extreme reading, and historically extreme readings in the gold-to-silver ratio have often preceded significant outperformance by silver. Sure enough, silver eventually caught fire and dramatically outpaced gold in percentage terms over the course of the year, and the ratio tightened significantly. But it's important to note that even after silver's explosive 2025 rally, the ratio is still historically elevated by long-term standards, which is one reason why some analysts continue to argue that silver has more catching up to do. What does all of this mean for you as an individual investor or someone simply trying to understand what's happening in the financial world? First and most importantly, it means that these price swings, as scary and as thrilling as they are not random. They are the result of identifiable forces, monetary policy decisions by central banks, structural supply-demand imbalances in the silver market, geopolitical tensions driving safe haven demand, leveraged speculation creating short-term volatility on top of longer-term trends, and a gradual but unmistakable erosion of confidence in purely paper-based financial assets. Second, it means that the way you respond to these swings matters enormously. If you're watching a silver price chart and you see the metal drop 6% in a day because the CME raised margin requirements and your immediate instinct is to panic sell, that's exactly what the leveraged traders who are being forced out are doing, and historically, panic selling during technically driven corrections in bull markets is one of the most reliable ways to lose money and miss the subsequent recovery. On the other hand, if you go in the opposite direction and lever yourself up to chase sharp rallies, you're taking on the same kind of risk that forces leveraged traders out in the first place when the margin calls come. The approach that has historically worked best in volatile precious metals markets is straightforward but psychologically difficult. Understand why you own these assets, size your position appropriately so that the volatility doesn't keep you up at night, and maintain your conviction through the noise if the fundamental thesis remains intact. If the reasons you believed gold and silver deserved higher prices, monetary debasement fears, supply deficits, central bank demand, industrial needs, are still in place, then a technically driven correction is not a reason to panic. It may actually be an opportunity. Third, and this is worth emphasizing, you need to understand the difference between paper exposure and physical ownership, because they behave very differently during periods of stress. When margin requirements get raised and leveraged futures traders get forced out, the price of paper silver contracts can plunge dramatically, and that can temporarily drag down the price you see quoted everywhere. But simultaneously, premiums on physical silver coins and bars can actually rise, because the people who want to buy actual hold-in-your-hand silver don't care about futures mechanics. They care about whether they can get the physical metal, and when inventories are tight, that physical metal commands a premium over the paper price. This divergence between paper and physical prices has been widening during stress events, and it's something serious precious metals investors pay close attention to. Looking ahead into the rest of 2026, the key variables to watch are these: Federal Reserve policy decisions, which will continue to move gold and silver significantly on every announcement. Any further escalation or de-escalation of geopolitical tensions, particularly anything that affects the US dollar or global risk sentiment. The ongoing trajectory of central bank gold purchases. If that pace slows, it removes one of the key pillars of the bull case for gold. Industrial silver demand data, particularly from the solar, EV, and electronics sectors. Any significant slowdown in those industries could dampen the industrial demand side of silver's story. And finally, the structural silver supply situation. Whether new mining projects start to come online in meaningful quantities, which would ease the supply deficit picture, or whether the supply constraints persist, which would continue to support prices. The most important thing to remember is this: the sharp swings you're seeing in gold and silver right now are not a sign that these markets are broken or that something has gone fundamentally wrong. They are a sign that these markets are alive and highly responsive to a world that is genuinely uncertain. Uncertain about inflation, uncertain about the value of fiat currencies, uncertain about geopolitical stability, uncertain about the long-term trajectory of interest rates and government deficits. Precious metals have always been the financial world's thermometer for that kind of uncertainty. When the reading spikes, it means the fever is real. And right now, the reading is about as elevated as it's been in almost half a century. Whether you're a long-term investor in physical metals, someone who trades the futures, someone who owns mining stocks, or simply someone who wants to understand what these historic swings are telling us about the broader financial landscape, the story of gold and silver in 2025 and into 2026 is one of the most consequential financial stories of our time. And it is far from over. Keep watching, keep learning, stay informed, because in markets this volatile, knowledge is not just power, it is protection.